You knew I'd start with this, right, folks? Are rates going to be higher or lower towards the end of the year in 2024?
Yeah, I mean, listen, I think we're close to the top end of the range. I mean, is it possible if growth continues to be strong, we push up a little bit? Listen, I think the one thing that's hugely important is that the Treasury's got to issue a tremendous amount of debt. And, every week we're getting $400 to $500 billion a week of debt that's coming into the marketplace. So, you got to absorb a lot in the markets. If, I think the Fed is pretty much done. Could they hike another 25 in December? Possibly. But I think short end to intermediate term interest rates have done virtually all they're going to do. Could long end interest rates drift a bit higher? I think so, because of the amount of debt that the Treasury has to put in.
So we could get a normal yield curve.
I think we're going to get a normal yield curve. As you get into next year, growth is moderating, inflation is coming down. We think as you get into the beginning of next year, you're going to get inflation in the high twos, 2 3/4, 2.85 or so. It's still elevated, but if you take real rates, so you think about, you're issuing Treasury bills at 5.6%. You get inflation at 2.70, 2.80. You talk about real yields that are pretty darn attractive.
Close to 3%.
Right, and I think what's going to happen is next year the Fed, to keep real yields at a restrictive level, they'll still have to bring the rate down because inflation is coming down. So, listen, I think particularly front to intermediate term interest rates, I think that we've seen most of what we're going to see there.
Later on today, we're going to get the Treasury refunding schedule at 3 o'clock. When was the last time this was news? And yet, now it's news. So I think we're expecting. There was huge numbers. As Rick said, there's huge amounts of debt being issued. I think it was $1 trillion in the third quarter. I think the estimates now, they're going to announce this today, but I think $825 billion or something is the numbers. And we're actually paying attention to this, and we never used to.
So if you take gross issuance, in November, I think we're going to see $2 trillion of gross issuance. Think about that, $500 billion a week of gross issuance. So that takes Treasury bill supply and coupon supply. The numbers are staggering. And by the way, it's not like they're going down. Because of the cost of the interest now, and people don't factor in, do you know for the last 10 years, the average interest rate on bills was 0.82%. We're going to issue bills this week at 5.60. So think about what's happening. The debt service, the cost to Treasury grows. What happens is you have to issue more debt. And so this is a big deal for going. I mean, $2 trillion a month of gross issuance, $500 billion a week. The numbers are staggering. It's part of why I think rates will stabilize here. I think you need to see the Fed start to bring that rate down, which I don't think will happen in the second half of the year. But we're going to get to buy these yields at these levels.
So the supply is staggering, but the demand may not be. But the Chinese apparently are not buying as much as they used to. The Japanese are not. The banks are not for whatever restrictions. Who's buying all this stuff?
By the way, so you hit the two of the big ones. You missed one. The Federal Reserve in 2020 bought $2.5 trillion. 21 they bought $1 trillion. Fed's not buying, they're selling. The banks, like you said, not buying, they're selling. And actually, I would argue international is net selling. Who buys it all? What has to happen, and I think what will happen over the next year or so, is households will increase their holdings. So they're buying bills today, clearly through money market funds and outright. What I think will happen in the next year or so is if Fed starts to cut rates, people say, gosh, I want to lock these yields in. Then I think people will start to go out the yield curve, and you'll start to see the households have to buy it. But that has to happen. Because, and by the way, same thing with agents.
Or rates are going to go through the roof.
Or rates can go higher.
Yeah, so all those equity investors sitting on the sideline collecting 5% Treasury bonds right now, yields right now, it's a huge competition for the stock market. As a stocks guy, that worries me tremendously. But you're saying that could be good news, though. Here, what would entice them to come back into equities, though?
So
or is this a permanent feature?
So no, I mean, listen. I think what happens. I think the equity rates still do okay, as long as rates stay here and or start to come down. If you believe that the Fed is going to start to move rates down in the second half of the year, if you think the yield curve can normalize, you could create a decent tailwind for the equity market. Listen, I think equities, if you said next year, what should my portfolio look like? By the way, you can get 5.5% in Treasuries. If you want to take a little bit more yield curve risk, go out to 3 years, 5 years, which I think is fine today, and maybe I'll do some investment grade credit, maybe you can get 7. So I get 7 in high quality fixed income. I think equities can get you an 8 to 10. You think about what return on equity for equities is 8 to 12%.
Yeah, that's historically, but a lot of people are saying it's not going to be the same going forward because of the competition. That's part of the problem.
Right. So are we going to see 25% returns in equities? I don't think so. But I think equities will do their job. I think the multiple will stay relatively unchanged. Can you throw off 10% growth of book value of equities? Listen, I think people will continue to buy equities. I'm pretty blown away. You think about U.S. economy this quarter grew 4.9%. That is staggering. That is the direct relationship to revenues for companies. As long as we can keep growing nominal GDP in this country, equities will do their job.
And where are you in the soft landing camp? We've been waiting for this recession for a year. A year ago, everyone was sure we would be in a recession this time.
Yeah.
Wrong, completely wrong.
I don't really get the concept anymore of landings. Like I think the world likes to talk about soft landing. The U.S. economy is 70%, consumption is 70% services. In 100 years, there's only been 14 negative quarters of negative growth in services. Services don't have cycles. Goods economy has cycles. When people say, gosh, we're going to go into a recession or a deep recession, you'd really need the goods economy come under tremendous pressure. The goods economy can be cyclical, commodity-driven, commodity-oriented. But I just don't, do I think, so this year we think GDP, real GDP, we think will finish at 2.5% real. Next year we think it's going to be 1.5% positive. So moderating, slower. But I think people underestimate. I call the U.S. economy the polyurethane economy because it flexes, it adjusts like a Tempur-Pedic bed, and it can take some pretty significant shots, and it rebounds. So I think we're slowing.
I love that polyurethane. So not Teflon economy.
No.
You're sort of playing on words here, but polyurethane.
Yeah. So I said that before.
It bends
it's incredible.
And flexes.
Yeah. So there was a commercial once. I remember the Tempur-Pedic bed. They showed somebody jumping on one side of the bed, and they didn't spill the wine glass on the other.
All right.
And that to me is like the U.S. economy. You can take commercial real estate, local banks. You can take an incredible increase in interest rates. U.S. economy, technology-oriented, energy-independent. Real productivity and innovation taking place, and a service-oriented economy, particularly as the population ages. You think about spend on healthcare, spend on education, et cetera. It's much more stable than, people talk about these cycles. I think cycles were something we saw 20 years ago.
Europe still underperforms global equities?
So I run a lot of equities. My global allocation fund's big, is oriented towards equities. So listen, I think equities will do their job next year. I think, I prefer U.S. to Europe. I think Europe's slowing faster. I think the multiples in U.S. are actually, if you take out the Magnificent Seven, although actually I think those stocks are okay because of their revenue growth, but if you take them out, your multiple, you can find a lot of stocks trading at 3, 4, 5 times cash flow. I've learned in my life, if you can buy companies, stable businesses at 3, 4, 5 times cash flow, that's pretty darn attractive. There are places like Japan that
are there companies like that are doing that you can do that now?
100%. So you look at parts of healthcare, autos, defense, home builders, energy. Yeah. There's a bunch of them.
In the last couple of months, they've gone into that territory. It's taken that much time.
Totally agree.